Hello guys and welcome. Today we are going to understand why we need to have discipline of wealth to create the long-term wealth that we plan for and also to achieve our financial goals. Before starting this video, my humble request, do subscribe to this channel if you are interested in personal finance and long-term wealth creation. Okay, so as the title of this video shows, we need to understand how to build the discipline of creating wealth and moving beyond performance trap to creating an architecture for long-term goal-based prosperity. I do almost 6 to 7 portfolio reviews every single day, and I see one particular pattern that most of the DIY investors are doing today. That is, they go on an app or a website and check the last 1 year or last 3 years top performing mutual funds, and they just blindly allocate their capital in the top three or top four performing mutual fund of the last 1 year, hoping that the next year or the coming years the same funds will continue to outperform other funds in the market. But this is one of the worst strategies to do in investing, and there is a data behind it, and that is what we are going to discuss, why this is something that 90% of investors are doing and why they are going to underperform massively in the coming years. Okay, so let's first start with understanding what is the seduction in the chasing of returns. Okay, so the first thing is that most people don't realize that the investing world is like a revolving door, which means that no one strategy is going to perform well in every single year. But most of the people don't realize that they there is an inherent instinct in us to build wealth, which often drives us, to invest or to hunt for performing assets which have performed well in the last recent times, what we call as the recency bias. And because of that recency bias, most people just go ahead assuming that the last year's best performing funds will continue to do well in the next couple of years as well, but that is not the case. So buying a fund simply because it recently reached the number one spot guarantees one thing, that is you are buying at the absolute peak of that specific investing styles cycle. Okay, so what is an investing style? There are multiple investing styles that are deployed by fund managers. We will look at some of them in this slides. Okay, but first let's understand the mathematical improbability of persistence, which means that why past years performers are not going to continue to be the next year's performance in the mutual fund or in any PMS, etc. And this has been shown with data in the last 20 years. So let's see, this is the top quartile funds for the current year. Okay, and these are the less than 10% in the top quartile after 5 years, which means that, let's say there were these funds which were top performing funds in the last 1 to 3 years, but the funds that will continue to perform, which were top performing 5 years back, will be very less. So essentially this funnel will filter out most of the funds which were top performing in the past few years, and only the funds that are exceptionally well will continue to perform, and new top performers will emerge, and previous years top performers will become laggards in the next 4 to 5 years. So there was an SPVA 2025-26 data. This is a study that was done, and in that study they found that 76% of Indian large cap active funds underperformed the benchmark over the 10-year period, which means that if you just chose the top three performing mutual fund in 2022 or 2023, there is a very high chance that you are sitting on those funds which are not the top performers in this category in 2025 or 2026. And this will happen again if somebody repeats that mistake in this year as well, which means that the top performers of 2025-26 in any category of funds will not be the top performer in the next 2 to 3 years. Okay, so we need to understand that the markets are a revolving door, or there is a cycle in the market. Okay, which means that investment performance is strictly cyclical. A fund topping the charts in 2024-25 did so because the specific style was in favor. So there are three types of style, or which are most prominent in the investment philosophy, or what the fund managers use to invest their funds. First is the momentum strategy or the growth strategy. Second is value investing, and third is defensive or contra investing. Okay, so this keeps on going in a cycle. Few years there will be an upsurge and high alpha generation of momentum strategies. Then there is a market crash. When the market crashes, the value investors, value fund managers, they find the best opportunities, they invest, and once the market goes back in the bull run from the bear run, the value investing funds do well. Okay, and then there is a phase where defensive funds or contra funds also perform well when both momentum and value funds are not performing well. And this is typically a 2 to 3 year cycle which keeps on repeating over the decades. But what retail investors are doing is, from 2021 to 2024, because momentum was very strong in the Indian markets, especially in the mid cap and small cap category, you saw a lot of SIP, a lot of AUM went into the momentum or growth strategies. But now, since the last 1.5 years, the market has been crashing. There is a high chance that once the situation stabilizes, uh, the value funds will find value opportunities and they will invest in those. And the next 2 to 3 years can be a value fund outperformance cycle. Okay, so that means that the people that are just looking at the past 1 year's top performing fund are actually investing at the peak of the cycle of that particular investment strategy. And this is the exact reason why the people who are investing in top performing funds of the past 1 year or 2 years see their portfolios underperforming massively in the next 2 to 3 years, whereas the other strategies are catching up and they are outperforming the benchmark, right? So this is the danger point. This is where most investors invest. And the danger point is that buying here means absorbing the burnt of the subsequent cycle rotation. In simple words, basically means that you are entering at the peak of that particular investment style strategy. Now let's look at the survivorship reality, right? Over the last decade, approximately 27% of Indian funds across categories were either merged or permanently closed. 27%, which means that many of yesterday's past winners no longer exist. The vehicle you chose for the next 20 years of your journey must actually survive this particular trip. Okay, so let's say you invest in one fund and that fund gets absorbed into some other fund, or the philosophy of the investment of that fund changes. What will you do in that particular scenario? Many times when we saw that there was categorization of funds, large cap became multi cap became small cap, etc. So that is something that keeps on happening dynamically, right? There are many funds that just close. Okay, so one has to understand why they are investing in one particular fund, instead of just blindly investing looking at the returns. Okay, now let's understand the invisible drain on capital. So this is the advertised market return that most people expect. Okay, then there is a taxation leakage of 12.5% of LTCG, assuming that you are investing or you're selling your investment after 1 year. And the frequent switching triggers capital gains tax. So people who just keep on churning their portfolio based on the past gainers or past gainers of last 1 or 2 years, they first of all have to pay STCG, LTCG tax. Then there are exit loads and transaction churns. Okay, then there is a behavior gap, which means that most people don't take the right decision at the right opportunity cost, which means that most people will not invest money when the markets are down. they will stop their SIP, they will redeem their funds. But when the markets are up and there is a overvaluation, that is where the retail investors enter into. So they enter at the peak and they exit at the bottom, and this has been happening for decades and decades together. This is the behavioral gap that retail investors fall into. So if you see, there was a research of Axis Mutual Fund where investors lose 5 to 7% annually by entering late and exiting early. Okay, so 5 to 7% annual gap per year, and compounded over, let's say, 10 years, can be a massive gap in wealth creation. So the actual return that the investor is getting is very less as compared to what can happen if they are doing proper goal based investing. So over 20 years, these invisible frictions can reduce final wealth by up to 30%. That's a big gap in the long run. Then we have to understand the mathematical cost of chasing returns. Okay, so this is the typical portfolio or equity curve of a person who is just chasing returns and doing random investing. Okay, and this is the equity curve of a steady portfolio which is goal based investments with proper investment horizon, and they have a steady equity portfolio. Of course, there will be drawdowns over here. Okay, it's not going to be completely smooth, but the equity curve over the long term has to be on the upside rather than just up and down and up and down. So here we can see a scenario comparison box. The steady holder invested 10 lakh rupees at 12% and held seamlessly, so their portfolio just kept on compounding. But the return chaser invested 10 lakh rupees at 15%, but sacrificing 2% every 3 years to taxes and churn, and of course opportunity cost. So the steady 12% holder mathematically outpaces the heavy tax 15% chaser over a 20-year horizon. Now we need to understand a necessary paradigm shift. This is the performance trap, which is most people are running after the next winner or finding the next winner. They are looking to beat the index in this particular quarter, and they want to be a market fortune teller. But with proper discipline through our Auris Wealth strategy, we do strategic asset allocation for the wealth of our clients. We fully do funding for life cycle goals. There is a strategic rebalancing in every phase of the portfolio journey, and there is a behavioral coach and architect with you as your wealth partner who will help you through your journey of investment, so that you don't fall into the behavioral gaps that we discussed in the last slide, what 90% of retail investors fall into. So if you see, a true driver of portfolio returns, what is the true driver of portfolio returns? And the 90% of the returns comes from asset allocation, which is the strategic mix of equity, debt, and gold. And only 10% of the portfolio returns are driven by fund selection and market timing. But most people focus on this rather than this.